Welcome to the Sloth Investor podcast with your host, Mr. Sloth.
Welcome everyone to episode 6 of the Sloth Investor podcast, an investing podcast in which you'll find out why I believe the humble sloth is the best animal to characterize successful investing. Jay, welcome back. How are you?
I'm doing absolutely fantastic. Now, Mr. Sloth, I was on your Twitter feed and I noticed I have to start the show off with this, a milestone for you. And oddly enough, it seems to sort of fall in the area of July 4th in the United States, which is a big celebration.
Absolutely, Jay. Absolutely. So we're recording this episode 6, during the July 4th weekend, okay? And it's unbelievable, but things have been going so well for the Sloth Investor. I'm 4 months now on Twitter, and I recently reached 4,000 followers. So it's been so good. I mean, things have been going so well. The Sloth investing revolution has really taken off. 4 months on Twitter, 4,000 followers. And this has taken place during the July 4th weekend in the States. And recently, the podcast was released onto Spotify. So not only can you now listen to the podcast on Substack, you can also now listen to the podcast on Spotify, which you might already be doing right now. With regards to Spotify, Jay, I have a question for you that I thought I'd never ask anybody, but Jay, I'm about to ask you now. Jay, are you a fan of Shakira?
Is there anybody who's not a fan of Shakira?
Absolutely, Jay. Absolutely. And that was the answer I was looking from you, Jay. You never cease to disappoint me, Jay. You never fail to disappoint. Thanks, Jay. Well, Jay, one of Shakira's perhaps her most famous song was Waka Waka, released in 2020. And there's that immortal line, "It's time for Africa." And listeners, this podcast hasn't turned into a music podcast. Don't worry, we're going to touch upon investing, of course we are. But the reason I mention it's time for Africa is because looking at my stats for Spotify, I can see that the Sloth Investor podcast, we've got listeners in North America, in Asia, in Europe, and Australasia, but sadly not any listeners yet in Africa, Jay. So you guys out there, you listeners, if you have any friends or family, any connections to Africa, pass on information about this podcast, because we would really love to see some listeners in Africa, okay, to take it further along in terms of our global outreach, okay? So
Is Shakira from Africa?
you know what? I believe she's Colombian. The connection to Africa is, I believe it's for the 2010 World Cup. Yeah. And she's actually married to a footballer. I believe it's Gerard Piqué, who plays for Barcelona, used to play for Spain. And the song was released in 2010 on the Epic record label. And Jay, if we were able to get some listeners from Africa, things really would become pretty epic for us. Okay, so that's what we're looking for. Okay, with that growth in Africa.
You talked about last week owning the world, and this would sort of our global outreach would be almost complete if we could get some listeners in Africa. I think that'd be fantastic. I want to sort of switch gears, because we were sort of talking about the acronym SLOTH in the last 5 episodes, and I'm wondering this week we're sort of touching on a different theme. We're going in a bit of a different direction. Can you tell our listeners what that direction will be?
Absolutely, Jay. So, the first 5 weeks, as you quite rightly mentioned, the emphasis has been upon me introducing my 5 bedrock principles, okay? And if you guys who are listening to episode 6 missed any of those, then please feel free to go back, okay? So episode 1, we looked at simplicity. Episode 2, low fees. Episode 3, owning the world. Episode 4, time. And episode 5, headstrong. Okay, and they are my 5 bedrock principles for investing. Okay, so they are representative of what I have learned about how to invest. But this week, as Jay quite rightly just mentioned in episode 6, we are changing tack. Okay, we're changing direction. Okay, because the theme for this week, and indeed next week, okay, because there's a lot we can cover in this respect, is anti-models, okay? And I'm going to tell you now how I became inspired to create the theme for this week's episode. And it's because of an author named Nassim Nicholas Taleb, Okay. And I'm going to share now a quote from him. And he talks about how really, yes, we can learn from role models, but we can actually learn quite a bit more from anti-models. Okay. And this is a quote from Nassim Nicholas Taleb. Begin quote. People focus on role models. It is more effective to find anti-models, close quote. Okay. And I think it's a really interesting insight there, particularly when it comes to investing. Yes, we can speak a lot about those great famed investors that we've discussed in the previous 5 episodes: Warren Buffett, Charlie Munger, Andrew Hallam, and so on. But over the course of the next 2 podcast episodes, we're actually going to explore some mistakes, and unfortunately some common mistakes that investors can make. Okay, so that's going to really set the tone for the next 2 episodes.
So a role model, if I'm understanding correctly, a role model is somebody you want to follow, but as you're describing perhaps an anti-model, it's more effective to follow or learn from an anti-model, which is what you should not do and what you should not follow.
Absolutely, Jay. You've hit the nail on the head. And I think that's really the crux of what Nassim Nicholas Taleb is telling us there. Okay, yes, we can learn from role models, but fundamentally, I believe he's arguing that it's more effective to find anti-models. Okay, what can we learn from those investors in particular? When we think about anti-models within the realm, within the context of investing, what can we learn from their mistakes? Okay.
All right, so let's move on to our first anti-model, and you have one by the name of Ian, a gentleman named Ian.
That's right, Jay. That's right. Okay, so we're going to focus upon 4 anti-models today, okay? 4 investors, and we're going to dive deeper into each of them, and they're going to enable us to really recognize and understand and appreciate how we can learn from other people's mistakes. And I'm going to preface Ian with a quote from Charlie Munger, okay? And Charlie Munger is the vice chairman of Berkshire Hathaway, okay? And here is a great quote from Charlie Munger. Begin quote. "The big money is not in a buying and selling, but in the waiting," close quote. Okay, so Ian is in fact impatient. He's impatient Ian. Okay, he's learned about investing. He's grown up in the States, for example, and he knows that there's money to be made in the stock market, but unfortunately, Ian is pretty impatient. Okay, and Ian just wants to get money quick. And he hasn't really got that mindset of time, okay, really enshrined within himself, within his investing DNA. And that's sad, because that, of course, is the 4th bedrock principle of the Sloth Investor, okay? And Ian, let me tell you about Ian. So Ian, around about the early 2000s, mid-2000s, he was really intrigued by Google, okay? And he followed the company, and he realized that Google's IPO took place around about mid-August 2004. In fact, it was August 19th, 2004. But following the advice of many investors, particularly the Motley Fool, I believe the Motley Fool says this as well, he realized that he didn't want to invest immediately in the IPO. You know, he wanted to let the dust settle and the razzmatazz subside. And he realized that, you know what, let's give it, 5 or 6 months. So what did Ian do? He purchased his first shares in February 2005, and that's around about 6 months after Google's IPO. Okay, so he purchased shares for around about $93 a share. So he purchased he purchased 54 shares at around about $93 per share. That cost him about $5,020. Okay, so a significant amount of Google shares around about 6 months after IPO. Okay, and these shares did really well. Okay, we can look at Google's revenue throughout the years. It's been amazing. Okay, we all know how Google has diversified, and it's been a really successful company. Now, 5 years later, what did Ian do? He sold his shares. Okay, so Ian sold his shares. So if we look at the stats, we look at the data for Google. Okay,
so he sold them in 2010.
He sold them in 2010. So he bought the shares initially in February 2005. He bought 54 shares for around about $93 per share. Okay. Now, 5 years later, he sold all of those 54 shares. Now, the share price had reached $263.40, and I'm using the 26th of February 2010 as my data point there. So it's pretty much 5 years later, almost to the day. And it's a nice return. It's a pretty impressive return, okay? It's
more than doubled his money.
Absolutely. So the $5,020 that he spent on those 54 shares has now turned into $14,224 US. That's a 183% change in 5 years. So Ian is he's feeling pretty happy with himself. He really, really is. Hey, that's pretty good indeed. But, and here's the thing. Instead of selling after 5 years, what if Ian had simply sat on these Google shares, okay? What if he had simply sat on these Google shares, okay? So I did a bit of research over the weekend, and I think you guys know where this is going. So at the close of trading on Friday, the 2nd of July, Google's share price was $2,574 US. That's just for one share. So one share of Google, $2,574 US, okay? And remember, if Ian had held on to his 54 shares, guys, I can tell you what those shares would now be worth. They would be worth $138,996 US, and that is a return, which is quite staggering, of 2,670%.
Now that is the perfect example of what not to do.
I know. Now, Ian, you might think that 5 years was a good amount of time. Wow, 5 years, you've held those shares. You even held them throughout the financial crash of 07, 08. You held firm. 5 years, great. 183% return. Wow, pretty good. Pretty good, yeah, but nowhere near as impressive as holding them for 17 years, okay, and getting a return of 2,670%, okay, and that's not even saying that you'd have to sell now, but just, continue to hold those shares. That's what they would now be worth, almost 140,000 US, okay. So for me, it's key to remain invested, okay. It can be tempting to look at the return of the companies in your portfolio and think, wow, now's a great time to sell and I'm up so much, but it's important to remain invested. Remember, inactivity trumps activity. Okay, like I've said before again and again, 99.99% of successful investing is simply about doing nothing, about waiting. Yes, 0.01% is about the buying and selling, but 99.99% is about simply doing nothing. And Jay, we can think about actually, what is it that compels many investors to get jittery or to sell and to kind of exit a position early? There are many things. We think about commonly, we hear about quarterly earnings releases, and there's a lot of razzmatazz and publicity about these quarterly earnings releases. Sometimes companies do well and exceed expectations. Sometimes they don't. If they don't, invariably what happens is the company's stock will plunge. Okay, perhaps quite drastically as well. We hear lots about analyst expectations. I've spoken before in a previous episode, I believe it was episode 4, about the tyranny of the calendar. Okay, that great quote by Morgan Housel. Okay, and that very often we look into a 12-month return, and in fact we shouldn't. We should zoom out and take that multi-decade horizon. And I actually stumbled upon a great quote here by Robert Shiller, who's a Yale economist, and it very much chimes with what Morgan Housel has spoken about with regards to the tyranny of the calendar. And this is Robert Shiller's quote, okay, beginning quote. 12 months is the time it takes the Earth to go around the sun. I don't see any other significance, end quote. Okay, so again, it's just really important to kind of zoom out and have that multi-decade time horizon. Okay, and I'm going to just talk here a little bit again about Charlie Munger, because Charlie Munger, I don't think gets enough recognition within investment circles. Yes, Warren Buffett, we know, gets a tremendous amount of publicity and acclaim. But again, here's a quote from Charlie Munger, beginning quote, "It's waiting that helps you as an investor, and a lot of people just can't stand to wait," end quote. All right. So the point I'm making here about our first anti-model today, Impatient Ian, I'm calling him Impatient Ian, is that you must become a Jedi of patience if you want to become a successful investor.
And I can't help but think of my own stories as you're talking about that. And we've talked about in weeks past how one of the biggest things that I've learned from my own mistakes is not paying attention to the sensationalism that in the headlines that you see, and not getting caught up in that. Either they can swing for the positive or swing for the negative. And I think it's Andrew Hellum who said it's not timing the market, but rather time in the market.
Absolutely. Absolutely, Jay. It's so important, okay, to have that long-term time horizon. It's one of the key points I've learned from listening to other podcasts, reading books, talking to people, and just being an investor now myself. Time in the market is so critical. Having that patient mindset. And again, it goes back to what we've said in previous podcasts. We think about accomplishments in life, whether it's learning to master an instrument, perfecting a golf swing, learning how to serve in tennis. Okay. All of those accomplishments take time. Okay. These things don't happen overnight. And it's the same case within the realm of investing. Okay. We must adopt that long-term time horizon when it comes to investing in the stock market. Patience is critical.
I want to talk about another animal that you have sort of, I know that you've actually written about before. Now you're sort of your role model for your investment strategy is a sloth. Your anti-model is a meerkat.
Absolutely.
Can you talk a bit more about that?
Jay, that's a great way to put it. For me, the sloth is the most appropriate animal to characterize successful investing. And indeed, like you quite rightly said just now, the meerkat is my anti-model. Okay, so again, just like with Impatient Ian, I'm going to preface Meerkat Mike. So Meerkat Mike is going to be our second anti-model, Meerkat Mike. And I'm going to preface this section of the podcast with another quote, and it's by John C. Bogle, the founder of the Vanguard Investment Company. And we've spoken quite a bit about John Bogle already, but here's this great quote. Okay, I'm going to share it with you now. Begin quote. "The courage to press on regardless of whether we face calm seas or rough seas, and especially when the market storms howl around us, is the quintessential attribute of the successful investor." End quote. Okay, so let me touch upon now why I believe the meerkat is the anti-model. Okay, and listeners, I've actually written an article about the sloth and the meerkat and the comparison between the two before, and I'll drop a link to it in the description for this podcast. Okay, you can find the article on Substack, but again, I'll drop a link to it within the description for this episode. All right, so there's not many investing books or investing podcasts that talk about a trip to the zoo. Okay, but if you were visiting a zoo, who would you rather see? Okay, who's more entertaining, the inactive sloth or the ceaselessly active meerkat? Now, I think I know what you're probably going to say. You're going to say the meerkat, okay? And I love meerkats, okay? So growing up in the UK, I can remember that meerkats were commonly shown on nature documentaries, even within adverts, okay? It's almost like everyone's favorite wild animal. People love meerkats.
Almost unpredictable, and you don't know what they're going to do.
Absolutely, they really are, okay? So my money would be in a meerkat. If you were to ask anybody who they would rather see, spend time watching, it's a sloth or the meerkat, my money would be in a meerkat. However, when it comes to investing, it's clear that the sloth is the animal that we should seek to imitate in terms of behavior. Okay, unfortunately, many investors behave like meerkats. Now, let's think about what we know about meerkats. Well, I've certainly learned, okay, by watching those innumerable amount of documentaries that I mentioned, okay? So meerkats, they tend to make animated, rapid, knee-jerk movements. They're on edge, ceaselessly moving around, anxious, seem to be worrying. And for me, this provides a great analogy to investing, because the way that meerkats behave is sadly also the same way that many investors behave. Okay, it really is. Okay, meerkats constantly on edge, worrying, feeling anxious. Okay,
on edge almost, and impulsive.
I know, impulsive. Okay, and we think about many investors; they behave in a similar way. And why is this? Well, again, it goes back to what Jay just mentioned a moment ago about the sensationalism of the financial media. Okay, the financial media and the information they put out, it's very often a catalyst for meerkat movements on the part of investors. We think about CNBC, we think about the innumerable number of YouTube videos now. This leads many investors to behave like meerkats, to take action that really isn't in their best interest. Okay, there's something great that Brian Feroldi, who's really active within the FinTwit community, and he's a writer for the Motley Fool. Jay, Motley Fool, did you hear that? That would be a great alternative, wouldn't it? The Motley Fool.
A good anti-model.
I like it, the Motley Fool. I like it. No, slip of the tongue there. He's a great writer. Okay, he writes for the Motley Fool, and decades ago, it really was the case that the problem was that there wasn't enough information. And Brian Feroldi tweeted about this recently. He simply stated that, I'm paraphrasing here, that, decades ago, the problem was a lack of information. And now we have too much information. And I actually think that's a great, great insight there. And it's so true because, yeah, we can listen to podcasts like you are now. You can watch YouTube videos, read books. But very often this accumulation of information actually paradoxically leads many investors to do the wrong thing and to behave like meerkats, to feel anxious and to do too much, when instead the best thing to do would to simply be to remain inactive and to behave like our good friend, the humble sloth.
Tell me a bit about Frank, and I think he sort of is queued up to be our penultimate anti-model.
Absolutely, Jay. So Frank is going to be our penultimate, okay, our second to last anti-model. And let me talk a little bit about foolhardy Frank, okay? And this is a mistake that some investors can make as well. It's over-investing when in fact there may be a significant financial commitment coming up on the horizon. Okay, so we know, we've spoken about this a lot, Jay, that over the long term, the returns of the stock market are very impressive. And I've actually got some data here from Ben Carlson, the writer of A Wealth of Common Sense, one of my favorite investment books. Okay, and this data relates to the returns of the stock market. So over a 20-year time horizon, the returns of the stock market are positive, 100%. Over a 10-year time horizon, the positive returns, you're going to get 94% of the time. So over a 10-year time horizon, 94% of the time, returns have been positive, okay? Over a 5-year time horizon, so if we take a 5-year time horizon, 86% of the time, the return of the stock market has been positive. Over a 1-year time horizon, we're seeing things starting to fall a little bit. 74% of the time, returns are positive. On over a quarterly time horizon, 68% of the time, returns are positive. Okay, so let's think about that. We can really see that, yes, over a multiple year time horizon, 10-year, 20-year time horizon, the odds are seriously stacked in your favor. However, we can see that over the short term, the stock market could go anywhere. Okay, the Sloth Investor would never deny that. And if we circle back around about 20 years ago, there were actually 3 years in a row where returns for the S&P 500 were actually negative. We look at the year 2000, okay, digging deep into my research, I can see that the return was around about negative 9%. 2001, the returns were negative 12%, about 11.9%, a negative return, negative 11.9%. And in 2002, things were even hairier, okay, minus 22.1%, okay. So this is some data that I've digged up. So we can see here that if someone were looking to send their teenage son or teenage daughter to college during this time, perhaps in 2004, 2005, but if they had overinvested their capital in the stock market, well, that wouldn't be good, because then we can see those 3 years, 2000, 2001, 2002, the returns were not great. Okay, so the key point I want to make is that, yes, investing in the stock market is great if you've got that long-term time horizon, but it's important to be pragmatic and to be careful that you're not over-investing, particularly when you've got a key financial commitment coming up in a short term, whether it's sending a child off to college, whether you want to go on this kind of around the world trip that you planned with your partner. Okay, so it's really, really important to make sure that you're thinking about your short-term expenses. Okay, maybe it's paying for building work on your home. Whatever the reason is, it's important to preserve this capital and just to make sure that you're being balanced, making sure that yes, you're invested for the long term, but also making sure that you're mindful of those short-term expenses that are coming up on the horizon.
You know what? And if I can touch on one of the things that I've come to learn over the years of investing is that, and Andrew Hellum does highlight this in his book, there's perhaps a sense of being scared off investments when the stock market's going down. But actually, that's if you've done your due diligence and you're either investing in an ETF that you believe in, or if you've done your due diligence on a company, that is actually the best opportunity in which to be buying your stocks and to stay headstrong and sticking with the plan, because there's, again, the opportunity, if you're in it long term, to make some real returns.
Absolutely. I couldn't agree more, Jay. So let's think about if you go to a store. We love it when there are items on sale. Wow, 20% sale, 30%. But when it comes to investing, we don't seem to think that way. But yeah, Andrew Hellum has made this great point before. When I've read Andrew Hellum's books, he's made this point about the fact that when it comes to investing, we should see those sharp market declines, such as we saw in 2007, 2008, as opportunities. Wow, we can take advantage, particularly if we've got that long-term time horizon ahead of us. Okay, when stocks are on sale, we should make the most of that. Of course, for many investors, what do? They don't take advantage and they get worried and scared. And what happens is then they buy when there's exuberance, okay, when stocks are all-time highs, instead of buying when stocks are on sale. So, Jay, that's a really good point. I'm glad that you raised that just now.
You've got one last anti-model to finish up with, and it's a young investor, Nick.
Yeah.
Talk about Nick.
Nick, let me talk about Nick. And I've given Nick the name Naive Nick. And this goes back to something we've spoken about, particularly in episode 2 of the Sloth Investor podcast, which was low fees. And Nick is our final anti-model for today. And sadly, Nick believes that investing is truly outside his circle of competence, and even though there's so much information out there today, we spoke about a moment ago, Jay, in terms of podcasts and books and YouTube videos and so on, Nick, he still just believes that, I'm going to park investing in a box marked as too difficult. It's not for me. Nick's a young guy. He likes to socialize. He's got a decent job. But when it comes to investing, he'd rather hand over the reins to what he considers to be the professionals, okay? They're professionals. And Nick is someone, he actually lives in the Middle East. He's someone who lives in that regional world. He's living the high life, he's doing well, he's got a tax-free salary. But he succumbed to some of the investment in professionals that live out in that region, okay? And Andrew Hellum has referred to many of these investment professionals as snakes in suits. And Nick has succumbed to the agents of persuasion, okay, that we can commonly associate with many of these people, the sharp suits, the financial jargon, maybe the nice swanky car, okay? So Nick has succumbed, and he believes that these people can help him out, okay? And that's not to cast aspersions on all of these people, okay? But certainly it has been something that I've become aware of, particularly when I lived in that regional world, that the fact that many young and old investors, particularly those with little prior experience of investing, have sadly suffered as a result of receiving poor financial advice. Okay, so like I mentioned, Nick works abroad. He lives in the Middle East, and he signed up with a company that sells investment products, a large international advisory firm. So, Jay, that this is not going to work out well.
I think probably one of the biggest things too is that when you're stuck, when you're confused, and you can be paralyzed. You talk about Nick, and I think about my own journey. Sometimes I'm paralyzed by I don't know which stock to invest in right now. And the default for me is go back to an ETF that you believe in. And as a Canadian, when I'm stuck and I've got that paralysis, there's so many good stocks and I don't know about this stock, I don't know about that stock. I simplify.
Yeah.
And I go to an ETF, VCN as a Canadian, or HXCN, two ETFs that I will park my money in. I'm dedicated to making sure I do a monthly investment. And if there's no stock that's caught my mind or sort of that I'm thinking about or I've read about, then I go back to my ETF.
Absolutely, Jay. Absolutely. And I really love how you touched upon it there, the first bedrock principle of the Sloth Investor, and that is, of course, simplicity. Okay, so I'm going to talk a little bit now about what happened to Nick. But like you quite rightly mentioned, the best thing for him, for someone who perhaps doesn't want to spend the time, commit the time to research individual stocks, would have been to simply buy a low-fee, globally diversified ETF, okay, to own the world, okay? Adhere to simplicity, okay? But sadly, what happened to Nick, okay, our fourth and final anti-model, is that he entrusted his money in an investment professional, someone who works for an international advisory firm. Because quite naturally, we think about when we have little prior knowledge within a particular domain, we go to the expert. If we've got back pain, we go to a doctor. Okay, we got a dental issue, we go to a dentist. We got an issue of our car, we go to a mechanic. It's natural, right? Unfortunately, within the realm of investing, okay, deferring to a supposed professional isn't always the best decision you can take. And during my research for this podcast, I stumbled upon a fascinating article that was published in the Daily Telegraph, okay, a British newspaper, in 2015. The author's name is Katie Morley, and the article is entitled "Exposed: The Rip-Off Investment Advisors Who Cost British Expats Billions." Okay, so in the article, Morley writes about how employees of such investment firms are told to prepare clients' paperwork and place it in blue folders. However, after the customer has signed on a dotted line, extra pages would be slipped into the folders, which include details of the charges that were previously unbeknownst to the naive investor, and in this case, naive Nick. Okay, and I just find it incredible. Okay, and this is something that has occurred within that region, and I'm sure it's occurred throughout the world. And we can just see how it's so easy for someone who wants to get started on their investment journey. And I'm full of praise for Nick because he's a young guy and he wants to invest his money. He wants to make the most of his opportunities as a young person. He's earning well. Okay, however, he doesn't believe that there are, suitable options out there for him. Obviously, he doesn't listen to the Sloth Investor podcast, sadly, for Nick. I hope he does now start to listen to the Sloth Investor podcast, and he takes that wrong decision. He entrusts his money, his capital, in a supposed financial professional, what Andrew Hallam, author of The Millionaire Teacher, refers to as a snake in suit. And unfortunately, the consequences are dire because it then costs him quite a bit of money to get out of that investment scheme. And just not good at all. And
this is, I have to admit, in my own journey, I was naive Nick. I don't know how to do this. I don't know. I feel paralyzed by my inaction. I was paralyzed, and it resulted in inaction. And I felt I needed to go to an expert, sign papers. I didn't know what it was talking about, but it doesn't need to be that. It doesn't need to be that complicated. It's not that difficult. And again, I keep coming back to when I don't know what to do. Even at this point in my investment journey, I just go back to an ETF when I'm stuck. And that to me, that has simplified my life. And it's exactly the first bedrock principle for the Sloth Investor. Just simplify. Go back to something if you're confused, if you're stuck, if you don't know where to go to next, make it simple. And that's an ETF for me.
Absolutely, Jay. And I think that's a great way to round off today's episode. It really is. Okay, simplicity. I'm saying it 3 times, guys, because it really is so important. My first bedrock principle. And I'm going to go back now to a quote from the first episode that we did. It seems like so many weeks ago now, Jay, but it's a quote by John C. Bogle, the founder of Vanguard. And he quite rightly, he stated, the late John Bogle, he stated, instead of looking for the needle in a haystack, buy the haystack. Okay, so alluding back to what Jay was saying, that if you can't find a particular individual stock that you're interested in, buy the haystack. Okay, and for someone like Naive Nick, for someone who's got little or no prior knowledge of investing, and he wants to keep things as simple as possible, buying a low fee, globally diversified ETF approach, owning the world in a low fee manner, is going to be the best approach for him. It's what's worked for Andrew Hallam. It's worked for me. It's worked for Jay, and it's worked for so many other investors. Okay, and I think that would be the best approach for Nick as well.
All right, thanks for tuning in, everyone, this week. And this wraps up our first session of anti-models. Stay tuned, though, because next week we have session 2 on our anti-models.
So long, guys.
For more tips, follow the Sloth Investor on Twitter at @Sloth_Investor.